What's going on, folks? In today's video, we are going to be talking about HP. I'm going to investigate the numbers of this business. So by the end of this video, you'll know what the company's doing right, what they're doing wrong, and what the intrinsic value is. So you'll know as a value investor if you're getting this company for a good deal or not. So HP reports their earnings on May 30th. So for us value investors to get ahead of the curve, this is why this video is dropping the day that it is. So I'm recording it prior to the earnings because when earnings comes around, this is where things kind of get a little bit shaky, where stock prices either jump up erratically or drop down erratically. But taking a look at HP, I don't think I can expect the stock price to drop down based off of this historic fact right here, is that the last four quarters of earnings for HP has been pretty solid. They've either beaten their earnings or met it exactly to analyst estimates. Along with this piece of information, going over to Dataroma, which is a phenomenal site if you want to track what super investors have been buying, like Charlie Munger, Warren Buffett. And speaking of Warren Buffett, he has bought an additional 15% of his initial stake in HP in the last quarter of 2023. So to me, what does that say? Well, we have a company that has had solid earnings over the last year, as well as one of the world's top investors has been adding to his position of this company. So currently, he must believe it's undervalued. But what do I think? Well, I'm no Warren Buffett, but I can give you my opinion based off of what I've seen here. So here is what I believe. With HP, I have it loaded up in the stock spec software, and here is what the company is doing right and what they're doing wrong. Now, this software here, if you want to get your hands on it, follow the links in the description box below. It's a 7-day free trial. And if you're new to the channel, this is a great tool to just quickly screen companies so you have all the insider information that you need to find out if a company is worth your time or not. So 7 out of 10 is what's getting rated for this company. Now, what this software does, it takes a look at the company's financial statements and ranks it out of a score of 10, which is giving it for HP. That score is 7, and it's only getting docked in 3 points. One being their current ratio sitting below 1.5. The software likes companies that are sitting above 1.5 in the current ratio. That indicates to us that they have enough assets on hand to cover those liabilities. Another one being the return on equity average being in the negatives, specifically being a negative 193%. That is not great, as well as their debt to equity sitting in the negatives as well, which is not great. We want to find a company that is in a positive range between 0 and 50%. That just means that they're fueling the business through equity and not leveraged solely on debt. But when you have a negative number for the debt to equity, that is an alarming amount. Not so much an alarming amount, but more so an alarming factor of the business that you're lacking shareholder equity in this company. So those are some pretty decent red flags that are really popping off. However, the other 7 things that are showing in the green categories is actually pretty decent. They have a low price to earnings ratio. So for a tech company, which is kind of unheard of, below 10 on average, the price to earnings ratio has been 9.63, which is actually pretty low considering. Currently it's at 11.89, but 9.63 is a steal for a tech company, which usually trade at a higher premium, like Apple and Microsoft. Those usually trade at a higher premium. Now, their EPS growth is up over the last 5 years, sitting at 200% increase. So if you've been holding on to this company, you should be very happy about that. They've been buying back shares by 14%. So they've reduced over the last 5 years, they've reduced their total share count by 14%. That is absolutely massive. So they must believe at some point that this company's stock price is undervalued, because why would a company buy back shares if they're overvalued? The net income is up, the free cash flow is up, return on invested capital is sitting at a whopping 36%. That's really good. And revenue growth is up at 5%. So low growth in revenue growth. However, it's up nonetheless. So you're seeing a lot of revenue growth. You're seeing a lot of free cash flow growth. The trifecta in their earnings is there, folks. So those are important factors that I take a look at, and obviously Warren Buffett does as well. If you're not looking at the free cash flow growth, you should start looking at that, because that is the lifeblood of the company. Free cash flow is essentially its king. Free cash flow is everything. Now, going along with free cash flow, here's another thing to keep in mind. On 5-year average, free cash flow comes out to be $4.1 billion. They do pay out a dividend, so if you like dividends, that dividend yield is 3.28%. Now, something to keep in mind, folks, is this dividend safe? Because you could buy a stock, it pays out a dividend, but based off the free cash flow, it may not be safe. Well, good thing to know that with HP, their dividend is currently safe because they pay out $1 billion in dividends. Factor that in with the 5-year average free cash flow being $4.1 billion. Don't have to worry about that. Currently, in the trailing 12 months, it is sitting at $2.08 billion. I'm not liking that, to be honest, because that means half of the free cash flow is being allocated towards dividends being paid. So now, it's a $30 billion market cap. If their focus isn't growth so much, if they've exhausted the amount of growth options, then maybe paying this dividend, it makes most amount of sense to this company. However, I'm not a huge fan of dividends occupying, I guess, this much amount of free cash flow. So cutting back on the dividend is something that I would like to see. However, you don't have to really worry about that if you're just collecting for the dividend because it is safe. Along with the revenue growth going up, that's something to consider as well, that, you know what, this company is able to pay the dividend and continue to grow. Now, I did say I was going to calculate the intrinsic value of this company, but before we do that, if you enjoyed the video so far, hit that like button and subscribe button. It means a lot to me. It means a lot to the channel. If you want to find more analysis videos like this one, definitely hit subscribe because I post a video every single week, if not 3 times a week. So, here's the price analysis section. This is a section of the software which allows you to make up to 3 different assumptions based off the historical numbers that the company has shown to perform over the last 10 years, if available, right? So here's the one thing that is a caveat to what's going on. The last year, there was actually a decrease in revenue growth by 0.79%. So I put that into my conservative estimate, along with 0% revenue growth over the next 10 years. So the revenue just stayed the same, and as well as a 2% growth to try to get something with a 5-year average. So what I've done here is use some really conservative numbers along with conservative profit margins and free cash flow margins, with a price of free cash flow sitting roughly where they've shown us to currently be at, which is 14.82, and a price to earnings ratio of 10, 11, and 12. Currently, we're at 11.89. So that being said, if you scroll down, I hit calculate. I already done this prior, but the current price is $31.30 at the time of recording this video. The average calculation comes out to be $28.98. Now, here's the thing, folks. These are some really low numbers, and it's important to know, even with the revenue growth decreasing by 0.7%, the conservative average is around $21. So ideally, if you're able to buy this company within between $21 and $26, which is not really far away if you think about it. Like a 52-week range is $24. So on the low end, we hit $24, and that was somewhere, where was that? That was back in September 2022. That seems to be at that metric right there. Oh, look here, in October, it was at $24. And this is being extremely conservative. If you agree with my aggressive numbers, then $38 or $39 rather, whatever your pick is, seems to be a buy. Now that is factoring in a 2% revenue growth, folks, over the next 10 years. And this is all factoring in for a 13% return. Now listen, with this software here, you can adjust what you want your rate of return to be. I like to use 13% because it's a little bit higher than what the S&P 500 outputs. But for me, for this company, if I had to go in on it, $24 seems to be the spot to get it at. But you might be feeling like $26 to $38 may be your pocket here. So $31 may be a buy for this business. Now, once the earnings drops, and the earnings comes out, and let's say the stock price does drop. Let's say they miss their earnings. There's still value to be had in this company. A one missed quarter is not going to be the end of the world, because you have to look at the financial health of this company. Is it a safe company to get into? Well, your revenue growth is going up. Free cash flow is going up, as we discussed. The only red flag that I can potentially see here is the current ratio going forward and the debt to equity ratio going forward, because as economic conditions get somewhat worse with high interest rates and just ongoing debt, a company that has a lot of debt, has a lack of assets to pay off that debt, can be quite shaky, but they're able to pay off their dividends. They can use their remaining free cash flow to pay down any debts that they may have. But it's something to consider. So folks, what are my final thoughts? Personally, I'm waiting for this company to go down to the $24 range before I decide to maybe pick up some shares. Warren Buffett seems to love this company. Maybe he sees something that I don't because he's doubling down on his position. But those are my thoughts. If you enjoyed the video, make sure you hit the like button if you haven't done so and hit subscribe. I will see you in the next one. Thank you so much for watching.